Woo! Here we go. Welcome back. True North, the investment grade Bitcoin podcast. Welcome back to episode 53. We've got a whole crew with us today. Let's bring them on stage. We've got Soleil, myself, Dan Hillary, and Ben Workman, and we are going to get after it today. We're going to talk about some of my favorite topics, that being risk. And for those of you that are new to True North, the investment grade Bitcoin podcast, we talk about everything here. We talk about everything finance, everything Bitcoin, and every Wednesday night. And we touch on Bitcoin treasuries, macro analysis, securitization and tokenization of Bitcoin, different products within the market, and general humanity trends, and hit on macro and everything happening in this world. Because in my opinion, this is the biggest story in all of finance, and the world is changing as we know it, and we want to make sure we're at the front end of what's happening there. The people that are on the screen are a mix of people that have been following Bitcoin for an incredibly long time and have been at the front of the securitization within the market and the financialization and the integration within these products and the existing financial ecosystem. So excited to talk to you about all of this stuff tonight. We got a fun agenda for you. I'm just gonna pull this up myself. And tonight we're going to talk about macro. We'll hit on metals, MSTR statistics update. We'll talk about what is credit risk, maybe dive into the strategy credit model a little bit and think through it. I think there will be some good conversation around that front. We'll contemplate the credit model, and then we'll consider downside risk of the perpetual preferred equity. We'll think downside risk to the BTC, downside risk to the pref holder, downside risk to the common stock. Think about all of those different components. And if we got some time, we'll get into bad bond of the week, which, quick hint, it's Japan. And, and we'll jump in there. So without further ado, maybe I'll pass it around just quick thoughts on what people are thinking about. Maybe I'll pass it over to you, Soleil. Like what's top of mind this week? And we'll start that as a kickoff.
Yeah, I mean, my credit score is finally good, and I wouldn't mind getting some credit right about now. There were some times when it didn't look like a good deal for the creditors sending me an application, but I'm all about it now.
High credit risk, high credit quality, 800 credit score. Right on.
Give or take.
Over to you, Ben. I mean, we've been burning the candle on both ends, getting deals done. We've just launched a secondary offering of our perpetual preferred equity SATA, successful $225 million raise there, and we're excited. What are you thinking about?
It's been a wild couple weeks here for us. I mean, we've been on a tear here to start out the year, but mostly the thing that's grabbed me right now is just watching this metals run. I mean, these metals are on a generational run here at the minute, and I think that you're starting to see a lot of FOMO follow-on starting to happen as we're hitting these peaks, with the feeling that these things are never coming back down and that they're never going to spin up a little bit on generating more of them and getting more to market. But wow, what a run, right? And if you had a post earlier today, Jeff, that I was looking at, which was kind of scaling the magnitude of this run that we saw just with the expansion of the market cap on gold. And, Bitcoin's clearly been lackluster during this run, right? You're seeing all these store of value assets really take off. But now you look at it and you start to see where these price levels are getting to. And I have to imagine that these are the levels where doubt starts to creep in to some investors' minds as to whether this type of a run can continue to be sustained. And if you start getting that capital rotation and it starts looking for a new home, and even a portion of this flows into Bitcoin, we could be in for some fireworks here over the next couple of months. So I'm excited to see how this plays out. These are the strange times that make investing in markets so incredibly interesting, and I'm watching this one very closely.
100%. Before we go to you, Dan, I've got a quick word from Tim Kotzman.
Ladies and gentlemen, what you're about to hear may be amazing, but it is not financial advice. It's for informational and educational purposes only.
Right. Always got to make sure. Yeah, that was a little bit of a glitch. Everything we talk about here is for informational and educational purposes only. We're here talking about what we see behind the scenes within the market, and how we think about the general marketplace from credit perspective, equity perspective, all those other things. So thank you for that, Tim. Pass it over to Dan. What are you thinking about? What's top of mind?
Yeah, I think what Ben's talking about obviously is hugely important. I've been pretty locked in on the whole stretch thing, and I think the stretch behavior, price behavior over the past few weeks has been quite remarkable, considering that Bitcoin has fallen 30% off its highs, and stretch just continues to march on ahead. Saylor's been able to issue a lot of stretch, and then all the behavior at 1x MNAV. MSTR common issuance. It's quite remarkable. And I think, I don't see a world in which the rate of capital acquisition by MSTR slows down. And I think there's probably been a lot of hard internal conversations. Are we going to expand our balance sheet at 1x MNAV? And clearly they are. And then furthermore, the market, is liking them at 1x MNAV. Like they've issued a lot of equity here, and they're not falling below that 1 times NAV threshold, which I think is massively important. It's something we were trying to figure out. We talked about it a lot, but now we're seeing it in action.
Yeah, that's a great point. And this is something that, we had a conversation with an investor earlier this week, and it's been fascinating to watch just the volume and how these preferred stretch specifically is trading. And it's like, who's selling? I think the question is who's selling when the price drops, and how do you think about these things, right? The incentive of the holder is to, if you know that strategy is going to do everything in their power to get it back up to 100, and then they're sitting on it at 100, you have incentive to be a buyer below 100, and anything above 100, you have incentive to be a seller. So it's fascinating when you start to think about the infrastructure of and the get into the mind of the buyer, like who's buying this and who's selling this at those different price points, and what's the reason for buying and selling at those price points. It's a fascinating conversation. And even people that have been working in the industry for 30 years are asking the same question.
Yeah, and I saw a little thing in the Bitcoin preferred group, and some guy was like, "Yeah, I'm just every month shifting a little bit more of my fixed income portfolio into stretch." And I'm getting to the point where it's I'm going from 3% annualized return on my fixed income portfolio to 3.5 to 4 to 5, as stretch takes over a majority of that portfolio. And I'm like, yeah, that's what's going to happen across the entire market, in my opinion. And it's happening in the, BlackRock preferred fund as well. Like this is just happening across all fixed income funds.
And you think this product is what, 7 months old? And I was trying to calculate what is the Sharpe ratio of stretch? Like how would this fit into a portfolio? And it's tough because the data is skewed given that they just went through an IPO. But if you take the last 60 days of trading data, the Sharpe ratio is like 1.15. And that's with the big drop that we saw in late November, early December. And if the instrument trades very similarly to how it's traded in the last 30 days, I think the Sharpe ratio goes significantly higher, like 2 or 3. And so then that question becomes like, how do you compare this to anything else within the market? This looks just far and away better than a lot of the other fixed income instruments in the market with their relative volatility and the return that they're giving in those other instruments. And the fact that these are liquid, it's been trading, what did it trade today? Another $100 million in volume today. It's been averaging $100 million in volume every single day for like the last month, which is crazy. That's a lot of volume.
I think what's particularly interesting about these, and I think we'll see whether this thesis plays out over an extended period of time, because I still think we're kind of in, that testing phase for these products where the market's really trying to figure out, how do these respond across different market conditions? Does the market respect the over collateralization positions of these? Do they like the cash reserve positions of these? But what I think is actually kind of interesting is that if you wanted to live within the Bitcoin ecosystem and you feel bullish about the long-term prospects of Bitcoin, but it doesn't mean that throughout the cycle, you don't have periods of time where you want to be risk on and risk off. I wonder if these products with their over collateralization and with these extended cash reserves start to become more of a risk off play for a lot of investors that are native to this space, where say you wanted to rotate, say people are holding IBIT for Bitcoin exposure at one point in time and Bitcoin goes on a run and they start seeing it look toppy, do they start rotating out? And is the place where you land that in something like Stretch, which is effectively giving you S&P returns in what a lot would consider a very risk off or a low risk type of a product? I think it creates a really interesting value proposition for investors out there. And we've been seeing a little bit of it because Bitcoin really hasn't been providing a lot of assistance here for this entire sector. And you've seen it, kind of across the market in the way that the common equities are reflecting that, and they've drawn down a fair amount. You've got a lot that are, at NAV, slightly below NAV, hovering in that range. And then you just see this continued demand for the preferred products. We saw it obviously with our offer, getting out the gate and doing the IPO, where we came out starting to raise 100 million and saw a huge amount more demand at 200 million. We had to go through the process where you're marketing that, and you're having the conversations with the investors, and you're going through that educational learning curve. And then the follow-on offering, happened in a matter of days. And the investor base was already educated on it, and there was a lot of demand there. And so you were able to get that done and find a market clearing price pretty quickly for the scale of the capital that we were trying to raise. So the demand is arriving, but I'm going to be very interested to watch how these perform, both when the markets start to run, right? Do you start seeing capital draw out of these products when it looks like Bitcoin might start going on a run, when people are no longer looking to go risk off? And does that get reflected with Stretch, kind of hovering a little below that $100 par mark, where they're not able to raise quite as much capital, on that one at any given time? And then when people go risk off, do you see that demand start to spike? Is this kind of the Bitcoin ecosystem risk off style equity of choice? I'm going to be very interested to follow that for a bit.
100%. I think this might be a good time to jump into just the statistics that we run through every week, because it is a good frame of reference to think about like balance sheet risk and where we're at relative to where we've been. So on the left-hand side here, so we've got a couple columns. We show this every week, and this is MSTR financial leverage. Maybe I'll clean this up and make it look better one of these days. But Bitcoin held as of January 15th, follow this column. Bitcoin held is 712,647. Bitcoin price 88,745. Last I looked, MSTR price 158. So they're holding $63 billion of assets. They have $2.25 billion USD reserve. $8.2 billion of debt, $8.3 billion of pref outstanding. So the prefs have now eclipsed the debt, which I think is a huge milestone. There was more pref outstanding than there is convertible debt. A big milestone for Strategy. Net capital on balance sheet, $57 billion. Annual pref payment, $879 million. So if you just take this net capital figure, which is the BTC assets priced in USD minus the debt, you get $57 billion. Effectively, they've got 68 years of net capital to pay the dividends. So the leverage ratio on the balance sheet, 9.4%, just incredibly under leveraged, right? There's very little leverage on the balance sheet. You think of amplification is the notional outstanding plus the debt outstanding gets you to 25% amplification on the balance sheet. Important to note here that the amplification, the pref equity is equity. It is not debt. There's no cliff maturity. They do not have to pay back that number. That's why they're not using it in the leverage calculation, because there is no repayment of principal. This is like an interest-only loan effectively into the future. So in order for the Bitcoin price to go, or the value of the Bitcoin they held on the balance sheet to go less than the debt on the balance sheet, Bitcoin price would have to drop to $11,210, which is an 87% decline here. I think it's incredibly unlikely. So why do we bring this up? And then this is further to the points that Ben and Dan were making here. Even if Bitcoin were to drop 50% from here, which I think is also unlikely for many reasons, a 50% drop from here would drop the price of Bitcoin to $44,000. The 200-week moving average is $57,000. Historically, Bitcoin has gone below the 200-week moving average in bear markets for short periods of time. I think the longest period Bitcoin traded under the 200-week moving average was the period of 22 to 23, in which we're talking calamity for Bitcoin, right? You're coming off the heels of a 1 in 100 year pandemic, interest rates were dropped to 0. And then in 22, interest rates ripped to 5%. You had a political regime that was trying to kill crypto. Celsius, BlockFi, FTX collapse. You just had calamity across the entire ecosystem. And at that point in time, Strategy had more debt on their balance sheet than they had assets on the balance sheet, yet they still had a long maturity date. But thinking about the relative strength of the balance sheet today, right? You've got 9.4% leverage relative to where they were in 2022. They'd be twice as strong today if there was a 50% drop in Bitcoin than they were in 2022. And I think that's just helpful framework when thinking about just where we are in a macro landscape, where we were in the past, and thinking about the relativity here. And what's on the horizon is potential change in the chairman of the Federal Reserve, who's very pro Bitcoin and probably going to drop interest rates. You've got an election coming up in November. If all incentives are aligned for the economy to be ripping on all fronts in order to retain control and power within the political system, and the infrastructure is completely changed. You think about 22, there's no Bitcoin ETF, there's no digital credit instruments. All of this stuff didn't exist before. Like the architecture and the plumbing of the market has fundamentally changed. So yeah, it's the Strategy balance sheet looks incredibly strong here, and stronger than ever. I mean, they've got 712,000 Bitcoin on the road to 1 million with product market fit. And we're here at year 1 of digital credit, and we're going to see what this leads to here in the future.
Yeah, their credit score is almost as good as mine.
Infinite credit score. Well, on that topic, actually, while we think about the landscape here, I'm going to quickly jump and shout out our True North event that we have on the horizon coming up. So we have True North Vegas. So we've got an event. It is an in-person event. It is happening in Las Vegas on February 23rd, Monday, February 23rd. It is on the front half of Strategy World. It is a 4-hour in-person event. This event will not be filmed. It will not be recorded. You have to be at the event in order to see what's going on. We have 43 tickets left at this event. And I just want to paint this picture of like where we're at here in this point in time. We're in year 1 of digital credit, right? This company Strategy issued $8 billion of this stuff last year or over the last year. And they've got capacity to issue $15 to $20 billion more of this type of instrument here over the next year. They've dubbed this their iPhone moment. And we're at the precipice of like the entire market changing, right? Dan's talking to people that are shifting their entire fixed income portfolio over to STRC. So there's going to be people within the industry. So myself will be there. The entire True North team will be there. We will have several people that are working in the industry, participating and interacting within this event. So preliminary schedule, I'll show you guys what this looks like as well for those that are interested. So the first hour will be kind of a True North discussion. I'm thinking live True North. The second hour will be presentations. And then the next 2 hours will be 8 different breakout sessions. So 2 sessions will go at a time. These will be led and moderated by members of True North, and we will have people participating that operate within the industry. So our goal is to give a really unique perspective of what it's like to work in the environment, in the Bitcoin treasury environment, what people are thinking about, what institutions are thinking about. I've got a handful of big breakout topics and discussion points on the left. Is Bitcoin dead? Thinking about macro. How are corporations and people making Bitcoin productive? Can a portfolio of Bitcoin products beat everything in the market? What's it like buying $500 million in Bitcoin? The mind of a digital credit buyer, insights from institutions, blazing the trail in the legal environment. Is paper Bitcoin real or a myth? Retail trading landscape, battling conviction versus emotion, international credit landscape, quantifying credit risk from an institutional lens. And our goal is to provide perspectives on all of these different things with people that are leading the charge there. So can't confirm the exact guests at the moment, but we are working on getting a really exciting panel of guests that are there to talk about these topics as well. Some of which you will have known, some of which that you are not familiar with. and that are sneaky working behind the scenes in the marketplace. So it's going to be a lot of fun. After that, we're going to have a party from 8 to 11. We want this to be an incredibly high alpha session. And then the party from 8 to 11 is to extend any conversations that you've had at the front half during the panel sessions or any of the breakout sessions. So yeah, I think it's going to be a great time. We're going to be prepared to throw a good party and really deliver on all of the alpha there. You guys want to add anything else?
Spam and beer at the party.
Spam and beer. Spam.
Hopefully
Moose
it's slightly better than that, but no, it's going to be awesome. We've already got people on the ground in Vegas scoping all this out, making sure that we get a good setup. And, you know, we're taking it a little bit of a different direction than we did with the original one by, you know, bringing in some of those outside perspectives and bringing in people who can have the deep conversations from an institutional lens that are operators in the space, that are investors in the space, that are capital allocators in the space. And I think it's going to provide a really unique insight into this entire sector as a whole. So I'm really excited about this one. It's shaping up to be a really awesome event. It's going to be a great time. Hope to see a lot of you there.
Yeah, absolutely.
Can't wait.
One other thing, we do have sponsorships available at this event. If you're interested in sponsoring this event and helping us throw a great party, not needed, but we love our partners. We've got a small business partnership and then 2 larger partnership options. The larger partnerships options will also include a bit of a sponsor banner participation in the future on our future streams. We're going to have a banner down here at the bottom that shows our partners that help support everything that we've got going on here. So if you're interested, there is a sponsor tab on mstrtruenorth.com/sponsors. If you click this link here, it'll send us an email, and we are happy to roll with that. Cool. Thanks for the support. Look forward to meeting everybody in person. Okay, cool. Should we talk metals?
Mm-hmm.
Because this is ridiculous. Like these numbers, I did this just a few minutes ago. Like these numbers are insane. So as of today, silver market cap 6.6 trillion. 6.6 trillion. Okay. The middle of last year, 7/28/25, the market cap for silver was 2.1 trillion. So right now, silver is the second largest asset on the planet. It's larger than any publicly traded equity. I think the largest publicly traded equity right now is Nvidia. It's like 4.5 trillion. So it's gone from effectively below the Mag 7 to surpassing the Mag 7 in the last 6 months, which is a pretty wild ride for the price of silver. If you go look at like the 25-year chart, it's just a crazy 25-year chart. One thing that is interesting that I found is an inflation-adjusted peak for silver. If you go back to the 70s when there was another kind of blow off top for silver, the inflation adjusted peak is around $148 per ounce. So I think this thing could have more room to run. I don't necessarily want to touch it. I don't want to touch anything that looks as completely vertical as this thing does. But I think the reality is you got silver is used in a lot of infrastructure, right? It's conductive for electricity. So it's used in building electricity units. It's used in computers. It's used all over the place. But I think the relative size and scale of its use case is relatively small. I looked the other day. It's so there's 2 billion computers on the planet, and each computer uses like a gram of silver. So if you were to double the number of computers on the planet, it would be something like you need $8 billion worth of silver at today's prices, which is like on a size and scale perspective, the size of Campbell's noodle soup market cap. It's just like so small on a relative basis. But, there are many other industrial use cases, but it seems like that concept of its industrial use case might be like slightly overblown. I mean, when people need to buy these things like for computers and stuff, the price doesn't matter if the demand is so high. So it's a bit difficult to rationalize some of these things.
Oh, but it tells you that you could see consumer good prices go up that are using it. right? That's going to be
True.
one of the problems here when you look at any of these metals that are used for any of these products, is that when these prices spike like this, there is the incentive for the miners to get out there and start mining more of this stuff and getting it to the market, because you've got huge demand right now. You're going to have companies panicking for supply because you're worried about these runaway costs of these inputs that go into your products. It's going to create some ripple effects out there beyond, just how we traditionally view these, just in that store value category and people kind of hoarding them as investments. On that utility side of it, it's going to create some downstream impacts to the products that we see. And particularly, you're going to see it in the electronics, clearly, because you're seeing them used there. So it's a little bit scary to watch it run away like this. The one thing that you always have to train yourself for is the fact that nothing goes up in a straight line forever, right? We've seen that play out several times. We've seen it.
Don't tell Peter Schiff that. Peter Schiff thinks gold's going to $15,000, and he was on Spaces yesterday going ape shit. So
yeah, okay, well, yeah, I guess whatever. But
it's going vertical forever, apparently. To Peter
but you
Schiff.
start to see, and now you go look at top assets by market cap, and now it's number 1 gold, number 2 silver. And just a few months ago, I think silver was 7 or 8. So they were down there a little ways. So they made a massive jump. I mean, they basically tripled. It's basically talk about they like it's a person, but it effectively tripled since like September, right? It's been just on this massive run, which, you gotta ask yourself what it is that's driving that and how scary is it, right? To see this much demand going into these metals and to see this consistent, right? It hasn't been, a flash over a matter of 3 or 4 weeks. It's been that sustained demand and the sustained drive up in the price here over the last, call it 4 or 5 months. And so you wonder how many people that are in the paper products are trying to get physical delivery at the moment, and what you're seeing there. If you're finding out that there's issues in that chain, it's just really, really fascinating to watch, because it's a pretty large macro indicator when things like this happen, that something's showing some cracks out there.
Yeah, and that's a good point about people waiting for physical delivery, because a lot of people are like, oh, well, let me just take an SLV position or a GLD position. But if they force majeure and just decide to settle some of these paper contracts in cash, you may not do as well as someone holding physical that can really just get the physical price. But then, of course, if you've got physical, you have to find someone that will actually be willing to take it from you. And, they're going to shave off a little percent for themselves as well. So it's not always going to be exactly the advertised price that you're going to be able to get. And you have to be a little bit careful trading the paper contracts.
It's interesting with the physical metal, because you actually see a fair amount of it. Like if you go and visit pawn shops and things, people go in there and try to sell it there. You try to buy it. You're usually, within a couple of dollars of whatever that spot price is. But I was seeing some reports that had widened, and what they would actually offer you was something like 15% below the spot price right now.
Mm-hmm.
And you were just hearing that there were all kinds of people trying to start to offload their physical metals here at this price. So I'm going to be curious to see if that ultimately translates into a pullback here. But it's incentivizing some people to really think about this, because if you'd been holding this for a long time and all of a sudden it's worth a significant amount, there might be some people that are ready to increase the quality of their life a little bit, beyond being able to look at the shiny stones. So I won't be surprised to see some incentives that drive people to sell some of their actual physical holdings here in the near term.
Yeah,
you guys are gold bears. I feel like I don't know.
Is it going to 15,000, Dan? Tell us, inform us.
I mean, the gold chart's super weird. So like, I'm not sitting here like betting it will go down, especially if these are sovereign buyers, right? Like this behavior aren't like, it's not the same thing as when Bitcoin ripped to 17,000 in 2017. Like these are real sovereign, kind of a change in the hedge, in the monetary order in the world. So like, yeah, I'm definitely not sitting here like thinking it's going to go down. But I think, the Tether story is really, really interesting. I think they're buying multi-billion-dollar allocations of gold every week, right? So they're becoming one of the biggest sovereign holders of gold in the world. And so like, that's crazy. And then that intermixed with the stable coin story, obviously Tether released a U.S. Genius Act compliant stablecoin recently, but they're also buying gold reserves and Bitcoin reserves for their Tether stablecoin. So like I think it's really interesting to think, like, is there a world in which Tether completely pivots away from short-term treasuries, especially if short-term treasuries go down to 2% at Trump's bidding next year? Like, that could be a crazy macro catalyst. And also, we talk about it sometimes at Buck, like Tether has such a great business, right? They're the most profitable company in the world per employee just because they sit and collect the short-term treasury bill rates in their treasury. But they're already diversifying away from the kind of U.S. sovereign debt, and so like, why are they taking that could be conventionally considered a risk and diversifying into gold, into Bitcoin, in this kind of stuff? And it's because I think that smart big money is realizing that this sovereign debt is in fact as safe as people want it to be. So maybe it's just like a massive repricing.
Yeah, it does seem like it's supply driven, not necessarily like debasement trade, store of value driven. And I'm not calling that it's probably got room to grow. I mean, double, triple, whatever. But eventually, people are going to attack those profit margins, and the supply will have to come up and meet demand eventually. And the question that I'm really asking myself is, do I want to wait another 20 years for this to happen to metals again, or own Bitcoin? And, we've got that statistic that nobody that's ever bought Bitcoin and held it for 4 or 5 years has ever lost money. And looking at the 20-year chart on gold and silver, it's like, okay, I don't have that kind of patience. I know I'm supposed to be low time preference, but that's a little bit much for me.
So Dan, you bring up a good point about Tether, and I agree with you. Like, I think there are a lot of companies that are starting to do this, thinking about reserves, thinking about lack of confidence in the sovereign, like U.S. debt, U.S. treasuries that they're keeping on their balance sheet. My only caveat to that is gold in the last 5 days has gone up 5.2 trillion. Let's just 5.1 trillion. That's 5,100 billions in 5 days. Right? Even if Tether's slanging $60 billion of let's just say $5 billion a week, that's $20 billion a month times 12 is 140. 20
240.
240 billion. We're talking like 5,100 billion has moved in 5 days.
You lost me with the numbers, Jeff. Oh, no, I totally agree. I totally agree.
Like, the scale is just like totally mind numbing, right? Like it just.
I think it just goes to show that people need to realize there's a lot of money out there, and like ultimately, like the price of Bitcoin goes up not because there isn't an ample amount of capital sitting around waiting to go into it, but it's because it gets adopted slowly. So I think people are too quick to compare Bitcoin to gold right now. Like, I think we're obviously expanding the total addressable market for digital sound money as Bitcoin goes up, and I think it's a really good thing.
I think that the number of the total asset number in the world has got to be massively gone up in the last 6 months. I haven't checked, right? Like the Jesse Myers in $900 trillion. Like just looking here at silver and gold going from 25 trillion to 45 trillion, you're up 20 trillion. But the rest of the stock market is also at all-time highs. Like the equity market's still hot, is like pushing all-time highs. The bond market is still high. It's like there's more money out there, and it will there's a lot of money out there. It's just interesting to see how this is all playing out. Let me put some more relativity here, right? In the last 184 days, the market cap of these two combined has gone up $20 trillion. Average market cap change per day is 100 billion. The Mag 7 today is 21.5 trillion. So over the last 184 days, silver and gold have gone up an entire Mag 7. Like the best 7 companies in America, their entire value of their market cap, that's what silver and gold have done in the last 184 days. That's crazy.
That's nuts.
That's just a crazy relativity. Like that's the best performing companies on the planet combined their entire equity market cap value. That's a crazy number.
No, and I mean this would not have been on the bingo card in in 2014, 13, as QE was starting to ramp up, that a gold rock would outperform the greatest capital market in the world.
Yeah. Yeah. Interesting stuff. Interesting times. It's fun listening to Peter Schiff like spit talk on the spaces and just completely dunk on the Bitcoiners. I think we'll have our time. If any of this gets remotely interested in digital scarcity, right? Like this is a scarcity. Gold is a scarcity story. Silver is a utility story. If there's any interest in going from physical scarcity to digital scarcity, I think like a splash of this capital moves Bitcoin very quickly. So yeah, it will be, I mean, time will tell. We'll figure it out.
Yeah, you got to give the bull guys like Schiff their time right now, right? I mean, you can't look at them and say, at the moment
He's definitely right.
not winning. It's been a pretty impressive run here. So I'm not mad at it. I think it shows that we've got a significant weakening in the confidence of sovereigns right now. I mean, clearly you've just got this disaster kind of brewing over there in Japan. Everyone's constantly watching what's happening there. That's sort of the canary in the coal mine there with the Japanese yen. We talked, I can't remember when it was, but we were talking about, the perception of the risk-free rate. And the risk-free rate is feeling more and more risky every day now. People are starting to dig into these balance sheets of these sovereigns. You're starting to see the weakness in the policies. You're starting to see the way that they're managing the economies and trying to drive the GDP growth. And a lot of that focuses on the US. We got the news today, right? They're not cutting rates, even though when you go and look at like the Truflation data right now, I think it's got inflation down at like 1.18 or something to that nature.
Insane. Yeah. Insane.
Which is pretty insane. And they're referencing figures from November, and you're starting to see that, and you wonder if we're at kind of a standstill here until Powell moves on from that role, right? Is he just kind of digging in place here, and we're not really going to see anything move maybe until May, and it's starting to create some uncertainty when you're seeing a lot of these numbers that are tracked pretty regularly by these more open source providers that have been, relatively accurate. And you're seeing that number come down, and there's a lot of weakness out there in the macro environment. So I'm not entirely surprised to see a lot move into these metals, right? We all look at digital scarcity and it makes complete sense to us, right? You've got the ability to transact value anywhere in the world using this, right? There's massive utility in the financial rails around a store of value asset like Bitcoin, but metals have been around for thousands of years. And so I'm not surprised, right? When we look at, Jeff, we were talking about this earlier, how small the Bitcoin world feels, right? You go to all these conferences, you're bumping into a lot of the same people, you're having a lot of the same conversations. We're still at the very early phases of seeing the major Bitcoin adoption. And I think it's going to come. The world's obviously transitioning to digital. I don't see us going backwards from that. It's accelerating forward. So that's going to be a reality of what the world looks like in the future. And I think that, having a digital asset with true defined scarcity like Bitcoin that can transact in a digital world as well is going to be something that's massively, massively valuable. But at the moment, when people are scared, they revert back to what they've always known. And what they've always known in the past, what their parents knew, what their grandparents knew, was you've got to have some gold. And I think you see some of that right now. And plus you see the sovereigns, right? And obviously the sovereigns are not immediately going to go pile into Bitcoin right away. I think it would be naive of us to think that that was just going to turn on a dime here. So not surprising, and to Dan's point, this could extend for a lot longer. And I wasn't necessarily, calling for gold to pull back and stop running entirely. My point was more, things don't go in straight lines forever, right? You tend to get some turbulence along that path. And so it's entirely possible that it continues to see sustained demand as long as people are starting to lose some confidence here in these governments to manage their economies. So we'll have to see how it plays out.
Yeah. What's the top? Is it like 60 trillion? Like could it double from here? Like, was that rational?
Yeah. There's no top if there's no fiat bottom, right?
There's no fiat bottom. That's true. That's true.
It's all about what the value is being denominated in at the time. And
if your denominator is broken.
Yeah. So Yeah.
if your denominator is broken, and maybe it's front running new money supply.
Didn't Sailor say that like the master plan for the U.S. would be to sell all their gold and buy Bitcoin and then just announce it and just drop the bottom right out of gold and Bitcoin pumps? I mean, 2026 would be the perfect time to do that. So
Oh my god!
I'm sure I have tons of important government people watching me. So
I think
Feels
could
like
happen.
right now they could just revalue the gold at these levels, right?
Mhm.
Really improve the balance sheet with that. That was a conversation a long time ago, and they were looking for budget neutral ways to build out a Bitcoin reserve, and one of those was to revalue the gold reserves. You know, now it would seem like a pretty good time to revalue the gold reserves if you wanted to really, pump that number up and see what you're working with. But yeah, I mean, that was one of the
surprised there's no
ideas.
gold in the vault. Actually,
Yeah.
Yeah.
Fort Knox is empty, and
The-
we actually can't revalue it.
The pawn shop might have more
Makes you
gold than Fort
suspicious
Knox.
every time, yeah.
Yeah, interesting.
But I think even if the US was going to do that, like I think you would want to see some more adoption of countries globally first, knowing that you're the one that can step in and really kind of take over because, you've got the stronger reserve currency that you can print yourself. So your ability to accumulate is going to outpace everyone else's. So I think you'd kind of want them in the game a little bit and then let them know that size of your economy matters, the amount of currency you got matters, having a money printer matters in the transition to where that's no longer a viable option, right? That's a very fiat game to play, when you can print the currencies. And the danger in an asset like Bitcoin to these countries is it completely changes the way that they operate. You can no longer just fund everything you do by clicking the magic money button all the time and pretending it's not happening or having an impact. You've got an actual finite, scarce value asset that you have to work within now. And that brings a lot more honesty to the process. And I don't think we're quite ready for that yet at the government level. I don't think they're quite ready for that yet. Honesty and accountability is not exactly in high supply these days.
Man, if somebody sold all the gold and bought Bitcoin with it, I mean that's probably, if a country did that, I would say that's probably a black swan positive event.
Mhm.
That's difficult to quantify. Speaking of fiat reserves, shall we talk about credit model on the pref equities? Because this is something I've been thinking about a lot. Actually, before we get there, and this is kind of to tie this together here, is thinking about the physical world versus the digital world. This is something I've been speculating and thinking about a lot, is how computers interact with assets today and how they will interact with assets in the future, and like how value is stored and held within computers and how that will change into the future. And like, it's hard to ignore and deny that trend is going up and to the right. Like computers are making more decisions. That's going up and to the right. Computers they've completely surpassed human intelligence, like far and away. I pretty much use AI like a calculator now for just kind of everything. And these computers, I know that banks are, and like high frequency trading companies already have tons of computer algorithms that are tied into like the equity markets and things that move quickly, and they're harvesting fractions of pennies on a dollar just based on being in different positions at different points in time. And when you think about like the future of underwriting an asset that's native to the decision making is going to be preferred. And what I mean by that is like the fact that a digital asset like Bitcoin is native to a computer, whereas a physical asset like gold is native to humans. Like the computers will prefer interacting with Bitcoin because it can underwrite the supply within the protocol. Like it's harder for a computer to underwrite like the geological supply of gold because that's unknown. Like a computer can't know what that is and know how society interacts with that supply, whether it's mining it or spending it or transacting with it, etc. Like the computers will prefer to interact with a native asset or native type money. And I mean, how long will that take? It might take a long time. It might take a decade. It might take 20 years. But I think the world is trending in that direction. Like as as you know, grandparents die away and they stop hoarding their gold, the younger people take it and they convert it into what's native to them. So
Yeah.
yeah, go ahead, Dan.
Yeah, I mean, I was just talking to my dad about this actually. Like, we're in this weird exponential phase where technology is progressing exponentially, right? Like, you guys have probably started messing around with Claudebot, and like, I mean, AIs are really interacting on behalf of humans and interacting with native kind of software in a way that is absolutely mind blowing. The applications are insane, but still, economic value is tied to the individual and the human, right? So, like, while people can't figure out where the value is being accrued, and I think part of this gold thesis is that like no one understands where the value is going to be accrued. Like in a year's time, like right now, I think Opus 4.5 is absolutely hands down the best model out there. You know, the open source Chinese models will be light years better than Opus is now in 6 months' time, 7 months' time, right? So who's going to capture this economic value if it's all being pushed to the marginal cost production? And like, there's a lot of boomers like who think, and I think they're starting to realize like yes, during the mobile wave, like the network companies were able to capture all the dominant networks were able to capture all the value, but like it's tough to say who's going to capture the value here because I don't believe there's going to be sort of fiat monetary capture in the way there has been with permission networks over the past 10, 20 years. So like, where does that leave value? And people are starting to chase scarcity, right? And they're chasing gold, but it's because money's still analog. Like money is tied to your personhood via a traditional, ledger system in the banking, in the traditional banking rails. So like that will change, but slowly. And so economic value is slow, but sort of technological progress is exponential.
Yeah, and it's happening at light speed right now. It's like deciding which AI model to use. It's like there's a new one every week, right? It's insane. I'm like, and I'm like asking my analyst, hey, go look at what's going on here because I'm using this, but should I be using that? And I like don't even have time to go analyze whether or not I should be like jumping and using that model or it's like it's all moving so fast, and like some people are dedicating their entire life to understanding how these things are moving. It is mind blowing. It is totally mind blowing. And if you're at a company where you cannot use AI, you're going to get left behind. Like if you're only using AI in your spare time, like you'd read a book after you're done with work, you are totally going to get left behind. Everybody that's using these things are, they're accelerating just incredibly fast. They're pushing the bounds of progress incredibly quickly.
I totally agree. But the thing I've been thinking about recently is anyone with ideas is just in a position of infinite scale and implementation. I saw a funny meme or something. It was like, it's something along the lines of, it's like hiring senior idea guy, junior idea guy, assistant idea guy, guy to go get lunch, more idea guys, so like, I think there's merit to that, honestly. Like if you have the ideas, implementation becomes free. And that is a crazy idea.
Yeah. I mean, just the fact that I was able to, use cursor code and I'm building like dashboards myself, and I don't like, I have the idea and I just go instantly type it in plain English, like what I want to see. And it's like, boom, it's there in front of my face. So I'm like, I didn't even have to learn any of the technicals. Like that is just insane.
Yeah, it's insane. So I think there's value. Go ahead.
No, I was going to say, for people that don't feel like, or maybe a little depressed, like I'm never going to be able to keep up with this, because it's going to be kind of impossible. It's just going to be, the best AIs right now are going to be free apps on our phone in 5 years or whatever. But because Bitcoin captures all of the deflationary advancements, all you have to do is buy Bitcoin. Like if you personally can't keep up with AI and technology, Bitcoin captures all of that on its own. So you can just stack sats and let technology go to the moon, and you can basically cement your your position in time now and just ride Bitcoin on AI's coattails.
I think the risks that are going to come with all these AI tools, right? I think you're getting efficiency and convenience at the risk of privacy now, right? Like we live in a world where even minor inconveniences will stop us from doing something, and so being able to plug in tools and have it do everything for us. I was looking at this, Claude or Moltbot, which is what it seems to be now. And it lives on your computer. It's basically got access to everything. It's got your emails, it's got access to files. It'll integrate into your Telegram and your Twitter and all of your social media. Like you're providing full access basically across your entire life. Every bill that's going to come into your emails going through that thing, and it's at the convenience of effectively having a virtual assistant for yourself. And so I'm always a little slow to adopt some of those, just because anytime I'm putting something on that's now got access to everything, even when they tell me that it's private, it makes me a little bit nervous. But it's clear that this is the direction that things are going. And I think that convenience and the speed of innovation and efficiency is going to take over, what we used to focus on with privacy. Right? Because now you've got to have everything out there in the open to integrate it all together, to make it really efficient, to allow you to be hyper productive, which is where a lot of people are going. And to Dan's point, there's really no idea you can't build now. There's no, and a lot of times, sometimes when you get stuck with one of the AIs, you go to the other AI to ask what's wrong with the first AI, right? And it'll fix the problem for you. Like the amount of time it takes to get from idea to product, as long as it's a digital product, is incredibly fast. I mean, I had an idea for something the other day and I built it in like an hour and a half, and it was exactly what I would have wanted. If I was, back in my old life and I was writing that code myself, it would have been months to get that done, to get through all the testing, to write all the unit tests, to figure out the right way to deploy it. Like just to get everything done would have taken a huge amount of manual effort, and that's no longer the case. So, it's a beautiful and a scary time to be alive right now, because you're watching the pace of this speed up and not slow down. And with every step, we're trying to, take friction out of our day-to-day lives. And sometimes that can be a slippery slope. So you just got to be aware of what you're doing with this stuff.
Yeah, I've seen all the posts where it's Claudebot lost all my money and traded. It's a trade to $1 million, make no mistakes. And it's Claudebot lost all my money.
Throws me back in time where we were doing the risk, and I'm going to date myself, but it was the risk reward analysis of, downloading a song on LimeWire or Napster or something. And you were just fully taking on the risk that thing was just going to brick your computer with some virus, But you could get that song that you could now listen to all the time without having to like record it off the radio or something.
Yeah, I still have an iPod full of thousands of songs that I've downloaded off of LimeWire. Shout out LimeWire. Good times. Good times.
Think it is an interesting development in having all your context sit in one space, because like ultimately the models are becoming like interchangeable, and once you have personalized context that gets built up over time, like I'm going to probably be using context that I'm developing now from my thoughts and actions and prompts and all that stuff in 5 years time. The same context, it'll be like a massive hard drive, or right now I run it in the cloud. Yeah, but you'll be able to port that into new models over time. So it's like the models are a commodity. It's just your context, your authenticity. That's like the only thing I can think of value in the whole loop right now.
And then this last week, ChatGPT is trying to take some percentage of like innovations that come using ChatGPT AI. Like that's a risk too. Like who owns it?
Yeah, you got to be able to own your context and your branding. I mean, digital ID. I mean, I know they've been like struggling with this. Like my dad tried to do a digital ID startup like 100 years ago, and they've been working on these sorts of these problems for like a long time. Then we saw Strategy Orange with like the same digital ID. I think there's going to be real use case, but like, does it get decentralized into Nostr? Like, where does your digital signature, reside? Like in the same way people like classic cars. I think in the future, people are going to like classic analog videos of people that record it themselves. So like in the same way you verify a 1975 911T and make sure all the parts are the same, the engine's stock, and there hasn't been any modifications. People are, I think, are going to do that on videos of people and want to see humans actually, creating. So I think, I mean, I don't know what's that's going to look like, but I think there's a massive market there.
I mean, the lawyers are going to have a heart attack when they have all these lawsuits about who owns what, where the property rights sit for all of the digital output that comes out of it. Oh my God. Good thing I'm not a lawyer, and I think about risk. Okay.
Wait until someone builds the next, like BlackRock Aladdin platform using an AI tool, and then it turns out that all that IP actually belongs to the AI provider, and now they own that tool.
Yeah, exactly. And then it's
See these
gone.
things coming. Yeah.
Yeah. Then software is going to zero. Like software, you can make software so quickly now. It's just going to
This is
take.
why anytime someone asks for, like predictions for 10 years in the future, like I have no frickin' idea. Because it wasn't too long ago where the thing that was getting touted around was learn to code. That was you were definitely
yeah.
going to be safe if you knew how to code, because those jobs were always going to be in demand. Applications were gaining. Everything in your life was going to be applications. These AI tools come out, and that is just getting kneecapped right now. Like now it's back to what they said it was going to be before, where, it was all the trades they thought were going to start going away and get
Plumbers,
automated. Now you
electricians.
can't find the handyman to save your life, right? Like nobody knows how to do anything anymore. And so it's in the real world, not the digital world. A lot of people know how to do things in the digital world now, but it's just fascinating to watch this develop. So, people always ask, like, well, what does this look like in 10 years? Like, I have no freaking idea, but I'm pretty sure the world's going to be more digital. And I think that that's kind of how I'm going to align my investment thesis here over the next 10 years, because I don't see that train slowing down one bit. I only see it exponentially increasing because I've seen it in the last 6 months.
Yeah, here you go. Somebody just posted this. I'm a developer and no longer code. I just use AI.
Yeah.
Exhibit A. Wow, it's crazy. Okay, let's switch gears a little bit, but also kind of in the same vein. And I want to talk about the preferred equity a little bit and the credit model, and think through this a bit, because this is, again, interaction between analog and digital, just on the credit front. And I had an interesting thought experiment the other day, and I'm going to share it with everybody here while we go and pull up the credit model. And my question to everybody here is, at what amplification percentage do the strategy preferred instruments have risk return parity with high yield corporate debt? And that's a pretty big question, because there are multiple things that you've got to think through here with that question. What is amplification? Is amplification a measure of risk? What is risk? Is risk volatility, or is risk default? What is credit? Like what is a credit claim? What does that look like? How does it look relative to the rest of the market? Does the denominator, like, is your balance sheet denominated in fiat or Bitcoin? And how do you start to think about these things compared to each other? And so what I did is I jumped into the strategy credit model, and I think I would love to talk to the strategy folks about this, but I think this credit model needs to be expanded on and built on quite a bit, particularly because no changes have been made since the addition of the USD reserve here, the 2.25 billion of USD reserve that's been added. None of the BTC rating, BTC risk, or BTC credit takes into consideration the 2.25 billion of USD reserve, which I think that needs to be folded in here into at least the BTC risk and the BTC credit model. So for those that are unaware of what's going on here, this is on the strategy website. You can click to the credit tab, and you can look at the relative risk profile of at least what strategy is indicated as the relative risk profile of these particular instruments. So BTC risk being the probability that BTC rating, so the effective collateral rating over coverage rating, falls below 1x at the end of the duration period. and it's the cumulative probability. And all of that is based on the underlying assumptions. So it's the price of Bitcoin today, the BTC volatility, your assumption of volatility into the future, and the BTC ARR, so the annual rate of return that you select. Let's just put 30 in here. So, why do I think this needs to be changed? And maybe let's walk through this a little bit more. Duration. So this duration number is the number of years to the put date for converts and the Macaulay duration for preferred equity. So if you look down here at the preferred stock, effectively what this duration number means is the number of years that you would need to hold the instrument in order to get your money back. So that's helpful when you're thinking about like a risk profile of this instrument. Like, what if I bought it today and held it for, I would need to hold it for 10 years in order to get my principal all the way back out effectively that you put in on day one. And so it's helpful thinking about it in that context. And bond managers, when they're thinking about portfolio, they're thinking about, okay, duration, like how long do I hold this? That's going to give me cash flow for that amount of period. I'm going to double my money in that time period. And all of this is a function of the underlying interest rate. So if you look at Macaulay duration of other bonds in the market or other perpetual preferred equities with lower interest rates, the durations will be, significantly longer because the rates are much lower. If rates are lower, the duration goes further out. Okay. Any questions there, team? No.
Nope.
Okay, cool. So let's jump to this BTC risk calculation for a moment, because I think there's a critical question here. So the cumulative probability that BTC rating falls below 1x at the end of the duration period. Okay. So my question to you guys, and maybe to like the audience as well, is why is it structured like that? What does the BTC rating falling below 1x at the end of the duration period mean? And does that mean that Strategy is not creditworthy if the value of the Bitcoin fell below the notional value of the preferred equity at the end of the duration period? So effectively what I'm asking is, does the notional value of the preferred equity even matter if there's if the preferred equity cannot call, like if there's no maturity risk of the preferred equity? Like, does the notional outstanding number even really matter? We'll start there.
Yeah. My gut response to that would be, because it matters in the MNAV calculation, and unfortunately the markets, it's going to be difficult for a market. So I don't think markets give Bitcoin a premium like they would expectations of future cash flow, even if we may believe Bitcoin will CAGR into the future. I don't think equities will price the Bitcoin CAGR into the current price of the equity, because then you would just price the future CAGR of Bitcoin into the current price of Bitcoin now. But so that being said, I don't believe that you could have real value in the equity if the total outstanding liabilities in the form of liquidation preference exceed the entire collateral stack, right? So like if we had 100% amplification, then the total outstanding liquidation preference would be cover the entire Bitcoin on Strategy's balance sheet. And so it would be difficult to say that Strategy's equity would be worth anything.
I'm not talking about MSTR. I'm talking about the prefs.
No, yeah, but I'm talking about what amplification ratio is appropriate. Is that what we're talking about?
Yeah, it's a little bit of that, but it's also the relative risk here. I mean, like, does it matter though? Because the value. Keep going.
Yeah, I'm just saying. So I think ultimately it's a function of how much amplification ratio can you apply to the capital structure in such a fashion that it's still a credit-worthy instrument. Is that the question? Kind of. Maybe I'm veering off.
Yeah, a little bit. Yeah.
But my point is, if the liquidation preference gets to 100% of the total outstanding assets, then it would be difficult to assign a value to the common equity without expecting a future price appreciation of Bitcoin. There are times when the market does not price in a future expectation of Bitcoin. So it'd be difficult in that scenario to raise capital. So the point being is, if you reached a 50% amplification ratio and Bitcoin were to fall 50%, then you'd be sitting at like a 100% amplification ratio. That, in my opinion, would be a risky scenario. So I think it's a function of where you expect Bitcoin to fall or appreciate to, and how much amplification you have.
Yeah, I think there's a few things there, right? So you've got, if you think about amplification at 100%, so you've got your notional outstanding. Let's just say flat interest rate, right? Let's just do it right now on today. If they had, let's see, what's the Bitcoin now? BTC reserve $62 million. Let's think about this. Actually, I did this in Excel. Let's go to Excel. Right here. Okay. All right. There's a lot here. I basically just rebuilt the credit model and I did it in Excel because I wanted to do some analysis here. So, okay, Dan, my question then also becomes, if Strategy's amplification goes to 100%, but they still had 2.5 years of dividend reserve, would you still buy the credit product?
Yeah, I think that's a good question to pose.
Right. Like, would you they're still credit worthy.
Yeah.
And the notional outstanding, then even at that point, like you would have, even at 100%, your dividend liability would be 10% of that annually. So you'd still technically have like 6, or you'd have 10 years of dividend coverage if your amplification was 100%, and a 2.5 year dividend reserve. You know what I mean? So like
there is a point at which like the dividend rate becomes attractive again based on the Macaulay duration going up for every 100 basis points of yield that the yield increases.
So
like if yield goes from 10% to 15%, your Macaulay duration got chopped in half.
Yeah. So my question then is, at 100% amplification, are the Strategy credit products still better than high yield corporate debt? It's
a tough one.
It's a tough one, right? Like, because you're like, well, they have the money, right? They've got 2.5 years. They've got 2.5 years of dividend payment. Like if the price of Bitcoin fell, I mean, shit, it would have to fall like 70% here in order for them to get to a 100% amplification. But even if it did, they'd have 2.5 years of dividend coverage already just in cash, liquid. Like you're going to get that. And then you have to make an assumption on Bitcoin. You've got to underwrite Bitcoin into the future, which that's tricky, right? Like, and that's what I'm trying to wrap my head around is like, I don't know if risk return parity between high yield corporate debt and these preferred equity instruments exists.
Yeah, you do almost wonder if a part of that, and I love that this is a conversation, right? It tells you how unique this space is just in general, because, when's the last time that you heard these types of discussions around any investments, really, where people are analyzing them at this depth? But you almost wonder if the Macaulay duration is what becomes effectively the most important metric to track, because are you really monitoring for the point where the collateral base plus cash reserve would fall below the asset value for full principal repayment over the Macaulay duration? Is that kind of the tipping point in that whole equation ultimately? Like, is it not the notional? Like, I get what Dan's saying about the liquidation preference, right? If you're evaluating it from a bankruptcy scenario, and if that's why you're buying these instruments, like, well, then that's going to be what's very important to you. But if you're looking at this from, are they credit worthy? Can they continue to meet their obligations? And when does that start to become a concern? The Macaulay duration may actually play into that, because what you're looking at is the overall asset base relative to the dividend obligations, which is the obligation, right? There's no principal repayment of the notional. By the time you get to the liquidation preference conversation, you're in bankruptcy, right?
Yeah.
So a lot of things have happened already by the time you get there. So in the meantime, before you get to that type of a scenario, you're really focused on the management of the dividend obligations. And I do think that that's probably the balance. It's probably where the assets come within striking range of the Macaulay duration. And then you're starting to take more outsized risk relative to the investment, because if you're looking at it and the assets match your Macaulay duration, you're effectively down to being able to break even over that period of time.
Get your money back. Get
If
your
the
money back.
assets
Doesn't move
maintain
at all.
value over that extended period of time.
Right.
I think
Yeah,
that's a really good point, Ben. Yeah, maybe the Macaulay duration is a lot more important than we're giving it credit for.
But that's assuming BTC flat zero.
Completely.
Well, it's like,
Yeah, you have to
okay, well,
model your own assumptions. You have to model your own assumptions for what you think Bitcoin's going to do, right? That's the whole model around this. It's why all of these businesses are so polarizing, is because everyone has their own mental model for what Bitcoin's going to do here over the long duration, right? You got the bears that say it's going to zero, and then you got the bulls that say, we're one day away from infinity tomorrow, and reality is going to be somewhere in the middle there. But that's what ultimately makes these. And what's interesting is you're seeing now billions and billions of dollars of investor capital being willing to underwrite that risk now, which is what's been so impressive about the scaling in the prefs and the amount of demand. And not, there's a lot of retail demand on these. We saw it going through the IPO, and we had a book, and there was a heavy amount of retail demand that came through in that IPO. But you're also seeing it on the institutional side. You have major institutional holders of these products as well. And, that demand is increasing. So they're more and more willing to continue to underwrite Bitcoin as a growing asset here into the future. And they're willing to allocate capital according to that. And I think that's a hugely positive sign for the entire space here. But this discussion about, how the market and how these allocators are viewing risk, to be honest, I'm not even sure this level of discussion has happened yet, right? You get into the early days where you've clearly got a buffer, you're not in a stress situation, you've got over collateralization, you have cash reserves, you're in a pretty solid footing position at the moment. And so the focus really becomes on the dividend yield and how that can impact your overall portfolio. If we start to see one of these drawdown events in Bitcoin, where all of a sudden we do see Bitcoin at the 200-week moving average or something like that, all of a sudden now you start to see how people start to shift their risk parameters in real time, which is part of the weird answer here. Is there is no singular model at any point in time, right? It is the risk on, risk off model, and it does adjust in real time based on those market conditions. And so you start to look at, where does that focus shift, in a risk off scenario? Then what does the focal point come on? And as I've, kind of talked myself into it, I'm starting to like the Macaulay duration match of the assets as like an anchoring point. I got to play with it more, because I haven't really thought that through all the way yet, but I like that as an anchoring point, and then it flexes one way or another here. But
So I think one of my favorite parts about this discussion is tying back what we were talking about earlier, is like the being digitally native risk. Like, this is digitally native risk. Okay, that hasn't existed before. You're not talking about physical risk. You're talking about underwriting the risk of an asset. Okay, now put yourself in the computer's shoes. I would want to arbitrage any discrepancies in risk across assets that are similar or like slightly different, right? If you believe you have the model of risk, you would want to trade in and out of these digitally native risk instruments where there's arbitrage opportunity, like that risk is mispriced in different places, especially if you have a clean expression of a balance sheet, like what Strategy is putting together here, and our goal at Strive. So that's an interesting concept, right? Like, I've talked about this previously. We've got all these preferred instruments, and the preferred instruments are creating now like infinite trading pairs where you can calculate risk in real time. If you come up with a risk calculation and you think the market is starting to think that way, and I think an interesting concept, an interesting topic. Mike's here. I'm going to throw him in as well. What's up, Mike? Oh, the other thing I was thinking about, and this came up from a conversation with it was Udi was trying to call me out on the old Twitter sphere, and was saying like, okay, what happens if the price of STRC drops to 50? Like, okay, well, if the price of STRC drops to 50, the yield of it rips to the roof. They still have 2.5 years of dividend coverage. Are you a buyer? Are you a buyer of STRC? That's a good question for you, Dan. Right? Like, are you a buyer of STRC at 50? Like, if Bitcoin price fell, the price of STRC dropped to 50 tomorrow.
Yeah, I mean, I'm just trying to figure out how to lever up on stretch as hard as I can. 'Cause, like, but not even then. I just mean now, because I like, the more I think about it, to your point, like, the less I think the probability of it falling that low, quite frankly, is, especially with the depth of liquidity that we're seeing now. Like, you could, in the early days, we saw that dip down to 90, and the volume was, half on a daily basis of what it is now. And so I think as the volume profile gets more robust, and every month that goes by and those dividends get paid, it's more of kind of a proof of concept, seasoned issuer profile. So I don't know. I think you'd want to buy like 3 times as much stretch as
triple leveraged
personally.
stretch.
I think there's this perception out there, because I've heard the term, like bank run and, the infinite spiral of the interest rate. And I think people forget that the interest rate adjustments are discretionary. Like, while there is a mechanical component to it in terms of how they're tracking the VWAP to figure out, what they're planning to do on the adjustments. If you get into one of these scenarios where, either you've got a black swan event that drags us down 50% again, or you get some weird market correction in these instruments where you see the price flash down, even if the balance sheet hasn't significantly contracted, it doesn't mean that they're going to start spiraling up the interest rates during that time period. Like, an answer can be sit still. Don't have to issue more, don't have to raise the rates. You've got the flexibility at management discretion to be in a holding pattern in those types of events. And so you don't end up in this position where you're compounding your obligations, which I think there's a misnomer out about there, because I've seen a lot of people like, well, if people just drive it down, they'll just have to increase the interest rate to infinity, and then they're busted.
That's
not real, right? That's not actually the mechanics of how it works. And so there's plenty of things to do during times of duress in the market, or even in just the specific equities, where you can control that outcome and manage your assets effectively. So I think that narrative is quite overblown on these.
Yeah, let me chime in here. So Jeff, I think that your response was great to Udi. So, and the part here is because it seems like people don't understand bonds. And as bond prices go down, the effective yield goes up. So let's just assume on STRC, its annual percentage rate is 11%. If the price goes down to $50 and Strategy does not change the yield component at 11% per year, the effective yield is 22%. And people are like, what witchcraft did you just use? I'm not a bond guy, but what I do know is, if I could now buy something for $50 and it pays 11%, that 11% was based upon a target price of between 99 and 101. Assume $100. So 11% of $100 is what it pays. If the price that it's trading at is $50, Strategy, let's assume they just don't change anything, the effective yield becomes $22, right? Because you drop the price now is half as much. And I don't know why people don't understand bonds. On the flip side, if the price was to go to 200, your effective yield would drop to 5.5, right? Even though they're still paying 11%. That's just the way that bonds and the way the prefs, they work. And that response that you gave to him was great. And that's when somebody would say to me, well, now what Ben is saying is, if there's this tail risk that happens, of course, guys, I want you to realize something. These black swan events, I mean, they happen like every year. I mean, the yen carry trade 10-10, when you had some exchange blow up. I mean, we get a black swan event every 6 months. I don't know. We seem to keep on surviving it. But anyway, with that said, I don't know why people don't understand the mechanics.
So I was thinking about this a little bit more too. It's like, okay, if the price of STRC went down to 50 and there's no buyers, you know who's a buyer is Strategy probably because they sold it at 90. And
Wait.
they can always buy it back.
I want to comment on that. Somebody made this comment that STRC, has a range between $90 and 100, right? And I'm like, no, this was by design. The IPO was done at $90 in order to attract those investors to make that difference. We said, hey, we're going to issue these at $90. And when it goes up approximately 11%, in addition to the yield, that's what attracts the investors to go in to create a market for it. And so the casual observer or on X is like, oh no, it's trading between 90 and 100. No, this was by design. And after a while, it just gets tiresome to report to reply to these people because they didn't do any homework. And you're like, really? Am I wrong? You guys correct me if
Yeah.
I'm wrong.
No?
No, that was the whole idea behind this. It's like, oh my God, they just never heard of, we're going to launch a new product and we'll do some incentive pricing to get people to see how great it is, in addition to already being double the typical rate.
Yeah.
By the way, I've been listening to you guys for the past hour. I think you're doing a great
Appreciate it.
job.
That, I'm gonna jump into this model here because I tried to break it, and maybe we'll think through this a little bit because I was working with Matt, and Matt, CEO of Strive. He's got an institutional background at fixed income, working at CalPERS, and we came up with this concept and this idea of BTC earnings driven interest coverage. It's this cell over here, and what this concept is like if you make an assumption on Bitcoin rate of return, which I've got over here on the left side, I put in here at 20. What this is doing is if Bitcoin gain is treated as earnings, and if you're taking an average time horizon of Bitcoin going up to the right, how much are the earnings on your balance sheet increasing relative to your dividend obligation? And so this is actually a similar framework to comparing bonds in the traditional market. So you can look at interest coverage ratios. So if you look at this table here, again, none of this is financial advice, but this is a perspective, and this is an NYU study that was done in January of 2025. It was looking at large non-financial service firms and their relative credit rating, which is this third column here, based on the interest coverage ratio. Anything at the yellow line and above or below, is considered investment grade by rating agencies, and anything below the yellow line is considered junk bond. So what I'm showing here on this number here, BTC earnings driven interest coverage for Strategy, I've got it 7.03, and this is based on their existing balance sheet. Okay, this is based on $64 billion in assets, $16.5 billion of notional outstanding. That gets us to an interest coverage ratio using a Bitcoin annual rate of return assumption of 20%. So if you're thinking long-term, Strategy would have on an earnings, their earnings would be 7 times the annual interest obligation. Okay, so where would that map? That would map relative to non-financial service firms somewhere in the AA category in terms of large non-financial service firms. This is interest coverage ratio and is pretty much like the highest tier investment grade. Obviously, there's volatility around that, but that's just using a 20% ARR. If I change that number to 30, let's just change it to 30 for funsies. That number goes from 7 to 10. Effectively, the balance sheet is growing 10 times or 10x greater than the dividend obligation on the balance sheet. Obviously, that would be the highest grade investment grade. So what I tried to do was I tried to break this. I tried to understand how much stretch could Strategy issue in order for the BTC earnings driven interest coverage to drop into the C category, which is where most high yield corporate debt is the junk bond category. So I'm trying to get this number down to like 1.5. And so I had to come up with some underlying base assumptions, and this is tricky, and we can play with this a little bit. But So I've got in here in this column, I could put in additional STRC sold, and let's just start with $300 billion, 300 E9. Okay, at $300 billion, thinking of fees of 1%, Strategy would net 297 billion. And I assumed of this cash that they raise, they store 2.5 years of dividend right off the bat. Just all of the capital that they bring in, they're just storing 2.5 years of dividend in USD right off the bat. So that means that of the 300 billion sold, they'd hold 82.5 billion. And then their net to buy Bitcoin would be 214 billion. Obviously, at today's Bitcoin prices, that would be just a ton of Bitcoin, 2.4 million. The price would run. So it's not completely realistic, but the coverage ratios are still helpful to consider. So the incremental dividend obligation at that point in time would go up by $33 billion. They'd have $33 billion of annual interest obligation. But they're also storing $82 billion of USD off selling the stretch in this example scenario. Like, I'm not forecasting what they will be doing, but I think this is an interesting concept. And so at that point in time, they'd have an $84 billion USD reserve, and they would hold, what is this, 276 billion worth of Bitcoin. So and with a BTC ARR, let's drop this back to 20. That would bring the BTC earnings driven interest coverage ratio down to 2, which would still be double B plus in this scenario using a 20% BTC ARR. And that's with Bitcoin at 87,000 where it's at today. Okay, so, and that gets them to an amplification ratio of 88%. All right, and I think the question that I've been trying to wrap my head around is like, does that make sense? Does it make sense to hold USD reserve on any share of STRC sold? That's an interesting question. And this is what kind of made me realize also that the USD reserve, like if Strategy is going to maintain a 2.5 year USD reserve and they're going to sell the absolute crap out of these preferred equity products, the USD reserve is going to grow relatively quickly. And they're likely going to be a very large continuous purchaser of US treasuries, which would make them like systemically important because they're continuously buying them if they're selling this preferred equity as quickly as we think they may here in the horizon, if we understand the risk appropriately. And that's an interesting value proposition. And then another question that comes up here when you're thinking about such a large USD reserve is, does that impact return of capital dividends? Does that matter? Are the institutions that buying this, do they even care? And how does that flow through? And I think this is all an interesting calculus. And the other thing I did is I assumed, let's just assume they issued $300 billion of this stuff, and they bought, for practical purposes, 2.4 million Bitcoin. And then the price of Bitcoin immediately falls to $50,000. And the amplification ratio increases up to 131%. The earnings driven interest coverage ratio at that point drops down to 1.38x, which in this scenario, I think they're starting to approach parity with high yield corporate debt, with a very large issuance and effectively 2.5 years of coverage based on the USD reserve. I guess the BTC rating at that point would fall below 1, which I think that may potentially be a concern if the notional value outstanding is an important statistic. I don't know. It's one of the reasons I've landed here is because my past life working in insurance companies, working with insurance companies were leveraged 300%. They were taking in, they had significantly more risk on their balance sheet than premium dollars that they were taking in annually. So and like the business model, it's like not very sexy, right? They're making 8% returns annually because of the float. They're taking the premium, they buy an asset, and then they pay out the risk into the future based on actuarial tables and all this other information. And so I was starting to conceptualize, like, does 100% plus amplification make sense? Like, does that break the model? And how can we start to think about it, especially because it's equity, right? Like, these aren't cliff maturity debt obligations. This is equity. And is that, like, how do we start to think about this stuff? Obviously not a problem that strategy has to deal with right now.
Yeah,
Right? They've
yeah.
issued $8 billion of this stuff, and I'm modeling adding 300 billion. But I think it's a valuable analogy.
Based on what metals did, that's a drop in the bucket. So
It
I-
is.
bingo.
But you know what, Jeff? Strategy already it already lived through a black swan event. It already lived through 2022 and 2023, and the company survived. It did not. Everybody always, it's always, everything with Bitcoin, it's like, well, you better get Bitcoin because when the US dollar, goes, it takes $1 billion to go buy a bunch of bananas. You're going to need Bitcoin, gold, and lead. People are like, lead? Yeah, for bullets. I mean, it's always that. With strategy, it's always like, okay, tell me what happens when it goes to bankruptcy. It's like, okay, what happens if Bitcoin trash, retraces 70%? Okay, well, that's already happened for strategy and they survived it. So I think what we keep on hearing with this is that there's always some cataclysmic event that's about, I mean, this yen carry trade blowing up. That seems to happen every year now, right? For the past few years. And I'm like, I don't know. I survived the yen carry trade. Not that I participate in it. And it's like these black swan events keep on coming. Remember, what happens when the next black swan event comes? I'm like, I don't know. You seem to be worried about this a lot. So, and I wrote a whole article about this was, hiding in plain sight. The strategy has these 3 buckets. It has MSTR that it uses to buy the majority of the Bitcoin that it holds. It has the prefs, and then so that's 2 fuel tanks, and the third fuel tank is the cash. And up until December 1st of last year, their cash holdings was basically 0. So we're basically 7 weeks later. They have $2.25 billion, whatever it is, 30 months outstanding. I think that they pushed that to whatever, 36 months, 48 months of cash, not because they want to. I think they never touch it. And it's just to make the S&P, the ratings company feel good that they have 4 years of payments in cash. They can write a check anytime. And they just say, look, we can make our payments for the next 4 years if there's a down market. Okay. How many years of cash do you need for a down market in something that never matures? I mean, it's not a rhetorical question. It's a
Yeah.
straight question. So all of the modeling you did here, it all makes sense. I mean, if you change this to a more reasonable number, if you say they're just going to do $12 billion of stretch this year,
Let's do 20.
let's make it, yeah, that's 20 billion, right?
So one additional piece to add here, Mike, right? And this is, I was just thinking about,
But scroll
like,
down a bit. I want to see where
Yeah.
4 falls out. 4.1x.
or it's investment grade, it's A.
Right. And I'm not,
A
that's not a
minus.
crazy, let's make it more realistic. Say 10 billion. $10 billion. They raised $2.5 billion at IPO. So at 10 billion, it puts it at 5.08 by your own calculations,
Yeah.
and it's A2 or higher. So that's a reasonable number for them to raise this year. 10 billion.
So Mike, one of the things that I was thinking about and when I was modeling this, which
Wait, hold on one second. I have never seen your table before ever, right? Correct? I've never seen this.
if you looked at the SATA presentation at the IPO, you would have seen it, but
I
that
did
would
not-
be
okay.
the only time. It was deep in the
I
SATA
did
presentation.
not see it. Okay. I'm just admitting I never saw this before. Go ahead.
One of the interesting concepts in this is what I wanted to do was see if I could create a model that where, like, would you buy the common equity of this company? Like, let's go back to the extreme example, right? 300 E9. Okay. Obviously, them acquiring 2.4 million Bitcoin right now doesn't make a ton of sense. But just look at the USD numbers, right? If this company held 277 billion in Bitcoin, and they had an $84 billion USD reserve and a $33 billion interest liability. Is this a sexy common equity? Would you like it? Like like that's what I'm trying to wrap my head around. And like this assumption, let's go back to the 20 or the 10 like you were talking about earlier. This assumption, Mike, assumes zero common equity dilution. So it assumes zero additional capital raised on the common stock. Okay, is that an interesting model? Like what does that look like? And again, you're thinking about credit in isolation, like on any one individual day, which is difficult. You have to model the stuff out in scenarios because the hardest part to model here is that Strategy has access to the common stock ATM to pay the dividends too, which it's tricky to model that third component. Like I think if you look at this business model in isolation, at the margin, even if you didn't have access to a common stock ATM to pay the dividends, I think the business model, as we've shown previously in some past episodes, that business model I think is still pretty interesting. Like if somebody gave you a Bitcoin today and you had to pay them $11,000, I don't know, $10,000 a year from here on out for the rest of your life. Actually, Mike, this is a good question for you. I asked this to somebody earlier this week and I kind of got poo-pooed on. Ben's laughing because he was on the call. Mike, if you had the ability today to get an interest-only loan on a house, but you had to pay the interest for the rest of your life, and you never had to pay the principal back, would you do it? And it's fixed rate for the rest of your life. Boom. And you got the loan.
Fixed rate and fixed payments.
Yeah.
And the answer to that is yes. And that might sound like a pretty bad idea, but it's not. And I'll give a good reason for that. First of all, if it's interest only, you're not paying back any principal. So when you get past the 15-year mark, it doesn't change. And that interest, as long as in America, it's deductible. So I have this deduction. So what happens is I'm not paying back the principal on the house, right? And the dollar gets inflated. Right. So, and Chris said the same thing here also. So would you do that? Well, sure, because you buy the house for $1 million, right? In other words, oh, you're in California. Okay, you buy the house for 500 grand, right? At 6% interest, I think you end up paying triple the value of the house if you pay it out over 30 years, given about a 6% interest rate. Somebody can correct me on that. But on this, you think about how long am I, in 30 years from now, I'd be 88 years old. I'm like, at 88 years old, then I'd have a paid off house. I'd sell it and give it to my, to the kids. In this case, what happens, to the house after I die? That might be a viable question.
Yeah.
But
fair.
For the
Like
most part,
the end of it, the perpetual. Yeah.
Perpetual, and then
If you
you
can
would
pass
say,
it down, if you can pass it
if you
down,
could
the
pass it
house
down.
and the loan.
yeah. And so at that point, the question is, that money that you'd put into it. I'll give you a real world example. Back in the olden days, the really olden days, 2005. This was before the 2008 financial crisis. Or I bought my first house, and it was in San Jose. The house was $540,000. The market was kind of weird. The interest rate was about 6%. So the dot-com bubble had burst in 2000, and the market kind of went down. And so you could do an interest-only loan. But what happened was I had money in my IRA account, which I did not want to take out and pay any form of taxes on it. And they had a no money down deal. So I had a great job. I had great income. So I did not take an interest only loan. I took a no money down deal. And what happened to that house in the olden days in 2005? I sold that house in January of 2018, and I'm in Silicon Valley. And on that house, the net gain was a shade under $1 million. Now, I lived in that house for 13 years. I put money into it, and I took a $500,000 deduction. So 20% on the remaining 400,000 was $80,000. And people are like, "Oh, I never make money on a house." Well, maybe you bought the house in the wrong neighborhood. Maybe you didn't live in it long enough. And so I
time.
did that, and I refinanced it. And wait, you want to hear the craziest part about this, Jeff? This was the craziest part about this in the old days. So it was a no money down deal, but I'd
No
have to
money
pay
down?
right. It was a no money down deal, and I'd have to pay PMI. So my loan broker said, "Dude, you don't want to pay PMI," and I'm like, "No, I don't." And he says to me, "Oh, I'll get you out of this, no problem." And I'm like, "Tell me how." He goes, "We'll finance the house for 540 grand with a $400,000 primary loan, no money down, with a $140,000 home equity loan."
A HELOC, so you had a double.
The
You're-
HELOC. So
the
that
HELOC
became
the HELOC.
that became the 20% down. And I said, and so I didn't have to pay PMI. And this was
Yeah.
all legal. This is in America, in
I
California.
did that in 21.
Right.
Yeah,
Right.
I did
So
the
this
same
is-
thing.
Yeah. And so I said to them, I said, wait a second, I'm taking even more risk. And you got me out of paying PMI. And the guy goes like this to me, shh, don't tell anybody. And you did this in
I
2021.
did it in 21. Yeah.
After the great financial crisis. It's like,
Yeah.
oh my God. And people are like, oh, I never heard this before. Well, talk to somebody that's done it before. I
Yeah.
didn't know that it existed. Wow.
I did.
You know,
I did.
after-
I did 10% down, and I took 10% HELOC, which got me to the 20% threshold, so I could get into a conforming loan. So I didn't have PMI, but it was like same concept. But it wasn't zero down. But I mean,
No, but
This-
so the point here is this: is that when anybody ever makes the claim, oh, Strategy or Strive or any Bitcoin, they're just doing financial engineering. It's like what?
yeah,
Everybody, if you're not doing financial engineering, then you're not playing the game. You know, hate the game, not the player. I didn't define these rules.
100%. Somebody wanted me to plug in a trillion here, so I'm going to do that. 1E12.
Guys, I got to jump off a little earlier than that.
All right, later, Dan.
All right,
good.
Bye.
See you, Dan.
Even if you plug in a trillion here, like if they sold a trillion of of SDRC and they held 2.5 years of cash back, obviously, like these numbers don't make sense. Like Bitcoin would have to go nuclear higher. They're not able to acquire 8 million of Bitcoin at $88,000. It's just impossible.
Yeah,
But
you know,
like you look at the interest coverage ratio, like that concept is just like it's still. This is where I was like trying to wrap my head around, like, does parity even exist? Like, does parity between high yield corporate debt and digital credit? I think there's actually a gap between digital credit and high yield corporate debt that, like, I don't think there's an amplification number. Maybe it's like 200%, maybe it's 300%, where like that like there's actual parity there. That was the game I was trying to work through.
You brought up another interesting question earlier, Jeff, and I'd be curious everyone's response to this. Say Strategy lost rock status, right?
Oh,
Say
yeah.
they've got this massive reserve, they're generating too much income off of it, or they, can't find ways to neutralize it. What percentage of the demand for, call it stretch, do you think goes away?
I don't think it changes. Yeah,
I don't think it changes.
I don't think it changes because even like we're talking about risk. I'm trying to break the risk model. I'm trying to break Strategy's risk model here, and I'm like cranking it as hard as I can, and I'm like, this risk still looks better than high yield corporate debt, like on a relative basis. I mean, who knows how this thing would trade? Like maybe it's more volatile, maybe not. I don't know. It might be so liquid at that point if there's 300 billion of this stuff outstanding. Like I just it's just so far, like the relative return for the risk profile of it is so far, like even if there isn't rock status, like and you get qualified dividends, it still beats everything.
Yeah, rock just seems like gravy. It's like not the primary, but then people were saying, "Oh, and it's rock." Like what? And it's rock?
Well, it's interesting, right? I mean, rock is it's a really interesting feature if you're an individual holding it in a taxable account, right? Then it's a massive benefit. But if you're an individual holding it in a retirement account, or you're an institution that, like maybe you're a hedge fund, and at the hedge fund level, you're not paying the taxes. So maybe it matters to some of your investors if it's passed through from there. But for a lot of the other institutions that are running pensions and endowments and all these other things, they're tax exempt anyways. So there's not really a rock benefit to them. And so the question really becomes, what percentage of the demand is coming through retail brokerage accounts that are taxable? And that could also be coming through like the FA channel as well, right? People with financial advisors, and if they're managing the accounts, that's probably where some of those taxable accounts would sit. But, what percentage of the demand is that cohort of investors? And so while I think, if it came to the point where they lost the rock status, there would initially be a big uproar. But I agree. I don't actually think it would really dampen the demand at all, because I think that these products are so unique and so attractive, right? When even just the yields they're paying out, right? It's higher than the average S&P 500 return. And so it's already an attractive instrument. So I just don't think it draws down that much. I used to think very differently. I used to think there would be this massive outrage and there'd be this huge period of time where all of a sudden you'd see this wild volatility in it because everyone would be, rethinking the product. But then I had to really get down to, well, what percentage of these investors get that benefit? And I think it's a lot smaller than people would expect. I don't know if it's 3%,
Yeah.
2%. I don't know, but I'm guessing it's small because there's such a huge amount of institutional ownership in these products, and that's not really a consideration for them.
I'll get, Ben, I'll give you a point here. Look, with all the stable coins that are coming out, and the purpose of the Clarity Act, what I believe is that they want the stable coins to be able to pay some form of yield to the people that hold the stable coins. I have not checked on this, and I could type it in right now into AI, but I would guess right now that those dividends that'll be paid on a stable coin will not be rock.
Yeah,
I could
probably.
guess.
Yep.
Probably.
Probably.
So we got 10 minutes left. I just wanted to cover up the last few things here.
Yeah.
I joined late. Look, I think this analysis is great. What I've witnessed over the past couple weeks is that people are still struggling with FASB fair value accounting. Okay. So
What is it? 2024?
yeah, and it went into effect January 1st of 2025. You could have done it January 1st of 2024, but now it's 2 years later, and I get on calls and people consistently don't know this. And so for the people on here, I just want to say this real quickly. It doesn't matter what Bitcoin treasury company you are or who has it. At 12 p.m., 12 at night, 11:59 seconds, the price of Bitcoin at the end of the quarter, and then at the end of the quarter, if the price of Bitcoin is higher, it's positive, from the starting price, or if it's lower, it's a loss. That is the same for all Bitcoin. If it's even, it's even. It's the same for all Bitcoin treasury companies. It's not the total amount of Bitcoin you bought with your average price and the difference between the two. It works each quarter and it resets. You guys all agree?
Yep.
Right. And then originally the Black Swan event last year at Strategies event was, so they implement FASB, they have positive EPS, they never sell the Bitcoin. Oh my God, that's going to trigger corporate alternative minimum tax. We were all sitting there, we're like, we want to talk to the accountants to get an answer on it. And then whatever.
Yeah, last May, we were all over it. Yeah.
Everybody's like, this is horrible. They don't even sell the Bitcoin. They got to pay taxes on it, even though the EPS is positive. Well, then it comes out, and this is the important part. FASB is used for GAAP accounting. IRS is taxes. FASB and GAAP, IRS over here, two separate groups. And the IRS treatment says, no, if you don't sell it, even if it's positive EPS, it's not taxable. And Strategy says this. Even to this day, people are like, so if I said, "But you know what CAM is? CAMT? Yeah. Okay, now reconstruct that back to me. I don't want to destabilize people on a phone call. I don't have time to listen to somebody fumfer over this. And so I just say it directly to them. This is what it means. And I had a guy fighting me on this. They got to sell the Bitcoin in order for it to be positive EPS. I go, no. He's like, yes, it does. I said, then you did not pay attention. And so, Jeff, would you have shown in this chart right over here, and this is the fault that we hear, we're a bunch of podcasters, don't know what we're talking about. Okay, you go produce your Excel spreadsheet with your analysis and take me through it. And they never do it. And so my takeaway with this, with everybody, is that I love talking about this. And I saw Dana's comment in the spaces. You guys get out of paying PMI and how to pay it. If the person you're talking to, financial advisor, your doctor, your lawyer, if they don't know something, they can't tell you anything about it because they don't know about it. If they do know about it, if your real estate broker, your mortgage broker knows about how to get out of paying PMI, then they have the opportunity to present that, the option to do that. If they don't know about it, they can't present it. And everybody's like, well, this guy's been doing the job for 20, 30 years. He might not know, that person might not know squat. And so listening to on these spaces, there's a lot of people that don't know squat. And after a while, I
Yeah.
can't call them out, but I just wanted to wrap up with this, that I think that, you guys do a great job. I listened to you guys here for, an hour and a half before I joined. And, and I just, the last thing that came up was this. It came up again today with Jameson Lopp. It's like strategy doesn't, post their proof of reserves. I'm like, for God's sakes, we went through this in May of last year. Saylor talked about it, and I have this invention. I don't know if you guys know about it. It's called the Google. Type in Saylor proof of reserves. Wow, there's the article. There's Saylor and said why he doesn't want to do proof of reserves. It's the Google, not even AI. It took me 1 second to do that. Then I used AI and I said, look at all the SEC filings and tell me how they handle their custodians. And I found that took like
Yeah, you get
20
custody
seconds.
information. I mean,
Custody, it tells you everything. And I said, here's the filing. It's 58 pages. It's like amazing that I can screenshot it and send it to the person when I start to do it. It took me like 3 minutes.
Yeah.
Look, I don't want everybody to say that AI is so great and then they don't know how to use AI or Google. You can't have both.
Yeah.
You just can't. Oh, AI is so easy to use, but I don't know how to use it. You
Right.
can tell I'm a little fired up, but anyway, we're wrapping down here. I want to.
Well, I mean, like you think about 700,000 coins, you're like, holy shit, $60 billion. It's crazy. It's a lot of coins, but like it's what, 3.5%. Right. So like historically, a lot of people have been selling Bitcoin that have been in Bitcoin for a very long time. You've got that switching hands. It's changing over to corporations. Corporations are accelerating. They're buying more. Tether's buying more. And it's moving from these people that were founders in Bitcoin and how Bitcoin's evolved into corporations that are going to hold this for the long run. And I mean, that's frustrating to a lot of people, especially people that have been in this for a long time. But yeah, we're getting down here. We got 7 minutes. Let's pass it around. Let's do final thoughts. I mean, Soleil, you've been observing everything going on here. What's on your mind? Final thoughts. Pass it around.
I'm going to go back to the gold bugs, slow clap for those guys. It only took you 20 years to be able to dunk on everyone else. But the whole, Bitcoin has no utility value isn't the dunk that they think it is. The lack of utility value is a feature, not a bug with Bitcoin. The utility value is a market distortion for its store of value price, and the store of value is a distortion for its utility value. So you really don't want these market interferences messing with the price of your store of value. There's people saying conspiracy theories that it's been manipulated and held down and things like that. And so you really just don't want supply and demand on something that may or may not be used in a computer chip or not. And so Bitcoin is the solution for that as well.
Absolutely.
I think
Pass
the
it- pass it
utility
back.
value of being able to transfer value between two parties with no middleman is perhaps one of the most important utilities on earth. So, they just don't know it yet, but that utility value alone is going to be massive, right?
Yeah, for sure.
I've had so many experiences this week that show me how powerful it is to be able to send value from one entity to the other entity and just have them get it. I can't tell you how frustrating a couple of
It's been
my
a long
days
week.
were working through the rails. I've never been less bullish on tokenization and all this other stuff that's happening in the back. I mean, I've had some really, not something to get into here, but I've had some really enlightening experiences now that let me realize just how nice it is for me to be able to send something to one person and they just receive it with nobody in the middle there. It's pretty beautiful. I'll just keep rolling here, Jeff, with mine, and we're not going to have enough time to talk about this, but one of the topics that I've really been focusing on a lot is liquidity. And I think that
Next week.
a lot of investors are skipping what the real measure of demand is in an equity. I think they look at the price always, and they assume that's the demand, right? If the price is low, demand must be low. And when you start looking across a sector and you start comparing the volume profiles of the securities that are trading, you see massive discrepancies. And like the reason why, like if there was no demand for MSTR, Strategy wouldn't be able to issue on the ATM. The volumes wouldn't be so incredible out there. Like that product is trading. There is massive demand. It's exchanging hands all day long, tons of it. When you look across the sector, it's not the same everywhere. It's only certain pockets where you see massive demand. Same thing in the prefs, right? You can look at the volume demand across the various prefs and you can see where that demand is. And I think people often equate price with demand. And I think that's a mistake because when you look at companies like treasury companies, one of the really enlightening moments for me when I started looking at these, and it's obviously helpful to be on the inside when you're hyper focusing on some of these things, is you realize that liquidity is your velocity metric. It shows you how fast these companies are going to be able to raise capital and acquire Bitcoin and generate yield and build up that NAV floor and build up that Bitcoin exposure. And, you can be as excited as you want, about individual entities, but if the stock doesn't trade, and that's one of the products they're selling into the market to raise that capital, is that equity, is that amplified exposure. The difference between trading $1 million a day and $100 million a day, if you were to raise capital at a 3% clip, is massive, and it compounds throughout time if that disparity stands. So just something to focus on. I think that we should deep dive into that here at some point, because I don't think people really have grasped how critical that component of it is. Price is going to oscillate, but the real measure of demand is the volume that's out there. So food for thought. We'll pick that up again later. It's a long conversation.
So Strategy's market cap as of today is something, I don't know, like 55 billion, something like that. But it traded 2.2 billion of stock.
Yeah.
So it turned over. However,
If there's no demand, liquidity would dry up.
Yeah, exactly.
It wouldn't continue to be elevated and expand.
Yeah.
But yes. We'll pick it up again another week.
Liquidity.
You can't get Chick-fil-A on Sunday, but you can get Bitcoin.
True.
Hey,
That's
can I
right.
wrap up with one last thing on
Yeah.
silver?
Yeah.
Do it.
Let me share my screen. Let me share this window here. Let's see if I got this working.
There it is. Yeah.
So this is silver here. This is a monthly chart on TradingView. The yellow line is the 200 average, and the whitish line is the 50 moving average. And you can see that here, 50 and the 200. So I'm going to do this line right here. That is January of 1980.
Mhm.
Okay, so that's the Hunt brothers. Okay. Then what happened was silver spiked over here, which is May of 2011. So let me do the math. 80, 90, 2011. It took 31 years and it barely broke the all-time high. You're like, wow, that's a long time to wait 31
Bag
years.
holder. It's a big bag holder.
That's a big bag. Then you got from 2011. Now, I'm not that good with math, but I think we're in 2026. And so what happens is this over here is it then took another 15 years for it finally to break the 2011 all-time high and to beat the 2011, sorry, to beat the 1980 all-time high and then the 2011. So you know what? The people that are in silver, you are much better at hodling than I am. Silver for that amount of time from the Hunt brothers. I get it. You bought it and you waited. Even if you bought in 2000 after the, right after the dot-com bubble burst, you had a good run for 11 years. But, if you look at the price then that happened from that bottom in 02, it was $4 and it did a 10x. That's a good run. But if you didn't time it right, what you would have is the exact same belly aching that we hear all the time. It's like, oh, you bought it at the top. You're the bag, you were the exit liquidity for everybody else. And so when somebody says to me, the silver people take a victory lap. By the way, what you see in there on the monthly, the RSI is at 95. I could tell you that this typically bubbles. It's really hard for them to last more than 3 to 4 months. And that's the longest, typically, 12 to 16 weeks. And that's long. In a Bitcoin space, it's usually about 12 weeks. But can silver go to a big number? Could it double from here? Yeah. You know what I'm doing? I'm not shorting it and I'm not buying it. Okay. I'm not doing. I'm just going to sit there on the side and watch this.
Ben would be selling you the covered calls on it.
Yeah. Ben's capable of trading this. I'm not. I'm just going to watch this on the sidelines. And when it's going to crash, you're going to hear the exact same thing we hear from the Bitcoin people. When's it going to retake the all-time high again so I can recover because I bought the top and now I got to wait? What do you mean I got to wait 15 years for it to retake the all-time high again? That's terrible.
The inflation adjusted all-time high, it was in the Hunt brothers 1980. So you're really looking at like 46-year hodl if you bought the top.
I was waiting for you to say that. So this was not this. I could do it versus M2 or something, and then the numbers would look horrible.
They look bad.
Right. So given right now to wrap up with this, I was pretty busy today, but I'm looking at this. Given the way I look at strategy right now, am I happy with the price? Not really. It's trading at $1,580. So for me, I'm like,
After
1580. I'm pretty good. And so with that, that's all I had to cover tonight. But hey, you guys did a great job. I just wanted to jump in at the end.
Perfect. Yeah, my final thoughts are the world is getting far more digital. We're seeing it everywhere you look. Every corner you turn, you're seeing different AI use cases. You're seeing different bots. You're like questioning what's real. People aren't using like Photoshop anymore. Everything's going to AI. Like the whole world's changing and moving really quickly. And it's going to hit finance. Like it will absolutely hit finance. It will absolutely hit asset prices. When, I don't know, it takes time for this stuff to transition and move. But you think about how quickly the world changed with computers hitting the scenes, like in the 2000s in the equity markets. You had a flood of all of these companies that were trying to move as close as possible to the New York Stock Exchange so they can get the information a split second faster in their computers so they can make a micro transaction and catch a trade in between an actual transaction, in between a trade. And like that's, moved faster and faster. So you've got high frequency trading is exploding. Algorithmic trading is exploding. And that really started with the equity market. And now with the advent of these digital credit instruments and algorithmic possibilities, risk can be calculated and transacted quickly. And I look forward to a world where a lot more of these companies have Bitcoin denominated digital credit products where you've got a Bitcoin balance sheet and your business is a function of like how that Bitcoin balance sheet grows. And then issuing credit products, then all of that risk can be traded in real time, near real time just like the equity market, which should foster liquidity. It should foster less risk in the entire bond market. It should foster better cost of capital for any businesses. There's so much that can be built by integrating all of these things into the equity world. So I think the world is going to be an exciting place. I'm an optimist, so I think the world's going to be a really exciting place to live in, assuming these things get integrated and gold doesn't just keep ripping faces off and become the new monetary order and everybody has to report to Peter Schiff. That would suck. So anyway, that's my final thoughts. Appreciate the time, everybody. 2 hours and 5 minutes. Thanks for watching. We will see you next week. Come to Strategy World. If you're attending, grab a ticket. We'd love to see you there, meet you in person. I think it's going to be a great time, a lot of alpha. And please like and subscribe. Apparently, my team told me that helps. So like and subscribe on the YouTube, and appreciate the support. Catch you next week. See ya.